Physical Gold Fund presents The Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold. Hello, I'm John Ward on behalf of Physical Gold Fund. Delighted to welcome you to our latest webinar with Jim Rickards in the series we're calling The Gold Chronicles. Jim Rickards is a New York Times best-selling author and the chief global strategist for West Shore Funds. He's the former general counsel of long-term capital management. He's a consultant to the U.S. intelligence community and to the Department of Defense. He's also an advisory board member of Physical Gold Fund. Hello, Jim, and welcome.
Hi, John. Thank you. Great to be with you.
I believe you're in Baltimore today in preparation for an event you have there tomorrow, correct?
I am. I actually lived in Baltimore for 5 years. I went to college and graduate school here at Johns Hopkins, and my daughter went to school here, so I have a lot of connections with the town and my publishers here. So Baltimore is one of my favorite cities. I'm just glad to be back.
Excellent. Well, we also have with us Alex Stanczyk of Physical Gold Fund. Hello, Alex.
Hi, John. Great to be here as well.
Alex will be looking out for questions that come from you, our listeners. So let me just say that your questions for Jim Rickards today are more than welcome. You can post them at any point during the interview. You'll see a box on your screen for typing in your question. And as time allows, we'll do our best to respond to you. Well, Jim, I happen to know, because you told me, that you've just been listening to Janet Yellen live at a significant press conference. What news and any first thoughts?
Well, that's right. Of course, yesterday and today was the two-day FOMC, Federal Open Market Committee meeting that they have 8 times a year. And that's when the Fed makes decisions on interest rates, either increase them, decrease them, or keep them the same. And if you go back to 2014, it's kind of interesting. Go back to the fall of 2014 or late summer, and what was Wall Street debating? They were certain the Fed was going to raise interest rates this year in 2015, and the debate was March versus June. You had your March people and your June people, and of course I said at the time that they would not be able to raise interest rates in 2015. Well, of course, March has come and gone. Now June has come and gone. This is the June meeting. They did not raise rates, and now Wall Street's debating. You have your September people and your October people and a couple December people. I'm sticking with my original forecast, which was that they will not be able to raise rates in 2015. So far, so good. Look, it is data contingent, data dependent, as the Fed says. I mean, I actually think that in my methodology, I stay a little more true to what the Fed says than the Fed does themselves. And what I mean by that is the Fed says they're data dependent, and I say, okay, data dependence, that makes sense, I understand that. Let's look at the data. The data stinks. The data is lousy. And yet the Fed keeps talking about raising rates this year as if somehow the economy was stronger than it was. And you say, well, what's up with that? I mean, why did they not get that? The answer is that they're basing it on their forecasts. So they say, well, okay, yeah, the data's lousy. We all look at the same data. They say the data's lousy, but they have a forecast that says it's going to get better. So based on that better forecast, they then lead the market to believe that they're going to raise rates. But then you have to remind yourself that the Fed has the worst forecasting record of any major institution. The Fed's forecasting record is horrible. Not just like anybody can get a few things wrong or be off by a little bit. We understand that. But the Fed is always wrong by orders of magnitude, meaning they say, you go all the way back to 2009 and look at their annual forecasts for the last 6 years, and every one of them was off by a significant factor, not by a little bit. So I see weak data today. I see the Fed engaging in happy talk, but I, again, remind listeners that they have a terrible forecasting record. I see no reason to change my forecast, and so I still don't think they'll be able to raise rates. But, let's see what happens. But so really kind of no news. Then people sort of read the tea leaves, and they look at the Fed statement and say, well, is there anything in there that might give us a little clue, even though they haven't actually voted to raise rates? But they lowered a lot of their forecasts. I just got done saying they have a lousy forecasting record, but I guess they're trying to get better. But they lowered their growth forecast for 2015 to 1.9%. That's really weak. Now, Janet Yellen did give a speech, and these speeches are not just things they slap together in a minute. I mean, they get reviewed by staff and they get reviewed by the governors themselves, or Janet Yellen's case, the chair. But she gave a speech in Providence, Rhode Island on May 22nd. And I read it carefully, and she really gave us their playbook. She said, well, what state of the world would they have to see to raise rates? What do they expect? In other words, what's their expectation behind the fact that they say they're going to raise rates? Well, she said very explicitly, she said, we're looking for 2% inflation, 5% employment, or 5% unemployment, and 2.5% growth. So there are the magic numbers: 2% inflation, 5% unemployment, 2.5% growth. But she also said that the Fed needs to be forward-leaning. The Fed needs to stay ahead of the curve a little bit, not let things get out of control. That makes sense. So all I did was I took those three numbers, I haircut them a little bit to say, well, what would the trigger be? So, take the 2% inflation, call it 1.8. That would be sort of a trigger. Take the 5% unemployment, make it 5.2. That's a trigger. And then take the 2.5% growth and make it 2.2. That's a trigger. And so when you see 1.8% inflation, 5.2% unemployment, and 2.2% growth, and all three of them are maybe 2 out of 3 trending in the direction that she would like to get to, then the Fed's going to raise rates. And I would say they'd raise them very quickly, probably within 30 days. So I think that, using Yellen's own words, we have the numbers, we have the playbook we need to know exactly when they're going to raise rates. The problem is we're not there. The latest unemployment was 5.5%, up from 5.4, moving in the opposite direction of her 5% target and my 5.2% trigger. So again, I don't have a crystal ball. I don't have a fly on the wall. I haven't bugged the boardroom at the Fed. I'm just using their own words and data that's publicly available to do some very straightforward analysis. So I still don't see any rate increase for the remainder of this year. Of course, it could change, but these are things I watch very, very closely. But meanwhile, they've lowered the forecast. They're trying to have it both ways. They're trying to talk rate increase and at the same time not actually do anything because the data is weak. And I think that act is getting a little old. I think the market's wising up. It's kind of interesting, right after the Fed announcement, this is all in the past, say, hour and a half, the dollar went down a little bit. Well, that's a sign that the market thinks they're not going to be able to raise rates. Because if you thought that they were going to raise rates in September, the dollar would trade up because you've got negative rates in Europe. If all of a sudden we're going to have higher rates in the U.S., then global capital flows would come to the U.S., the dollar would catch a bid and the dollar would get stronger. But the fact that the dollar traded off a little bit, stronger euro, weaker dollar, that means the market thinks that they're not going to raise rates, and I think that's probably the right conclusion. So that's sort of my analysis. Chairman Yellen is still speaking live as we speak, but unless she says something earth-shattering in the next 10 minutes, I think that's where we're going to end up.
Well, Jim, let me turn to a topic that you've been talking quite a lot about recently, and that is the bond markets. And in particular, you've been sounding the alarm about liquidity in the bond markets, or rather lack of it. Now, given how central these markets are to the global financial system, this sounds on face of it quite serious. Could you explain what's going on?
Sure, and just to give the listeners a little background on my association with the bond market, I talk and I write and I give presentations quite on a number of topics, the international monetary system, but I talk quite a bit about gold. And of course, the minute you say what I call the G word, the minute you start talking about gold, you get labeled as a gold bug or whatever term people want to use. And I think because I talk about it frequently, people think, well, gee, I must have been sitting in my basement the last 20 years counting a stack of gold coins. And sure, I'm a gold investor and I recommend gold to clients. Not too much. I recommend about 10% of your investable assets. But I don't really regard myself as a gold bug, and unlike some analysts, I have not spent the last 30 years in the gold market. I spent the last 30 years in the bond market. First, I started my career at Citibank, but a big part of my career, I was general counsel and chief credit officer of one of the largest U.S. government securities dealers. It was a private firm at the time. We sold it to a Japanese bank and later acquired by RBS. So when you hear RBS, Royal Bank of Scotland today, that's my old firm. But we were one of the primary dealers in U.S. government securities. And for those who don't know, primary dealer is a designation. It's something you're selected by the Federal Reserve Bank of New York as an eligible counterparty for bond transactions. So just kind of do monetary policy 101. When the Fed wants to increase the money supply, which they have been for a long time, they buy bonds, and they buy bonds with money that comes out of thin air. And when they want to decrease the money supply, they sell bonds, and you buy a bond from them, you send them the money, and the money goes poof, it disappears. When they buy bonds, you send them the bonds, they send you the money, and the money comes out of thin air, but somehow it ends up in your account. So that's how they create money or destroy money if they want to, or reduce the money supply. Well, that's a lot of buying and selling bonds. You need someone to buy or sell with. You can't trade alone. And so they have a list of approved counterparties. It's about 20 banks, all the big banks, the ones you would expect, and they're the so-called primary dealers. Well, I spent 10 years of my career, as I say, as a chief counsel and chief credit officer for one of the primary dealers. So I spent a lot of time in the bond market, and that's really my roots more so than gold or other hard assets. And when I was doing this in the 80s and then later worked for a hedge fund, long-term capital, that was a major bond trader, the 80s and 90s, kind of the heyday, if you will, of the bond market, liquidity was a given. There was almost no size that you couldn't buy or sell. So if you wanted to buy $100 million of 10-year notes or $250 million of 2-year notes. I mean, these are large orders. You just pick up the phone, or today it would be automated, and you put that order in and you get filled just like that. And the bond dealers, and as I say, I was one of the bond dealers, we made two-way markets. We were buyers and sellers. So if you want to sell, we would buy from you. If you wanted to buy, we would sell to you. But we committed our own capital most of the time. We didn't get too one-sided. We weren't reckless, but we would step up and execute the order. It'd be in our inventory, maybe a short period of time. Maybe we would want to hold it in inventory. Maybe we would like to trade. Maybe we'd have it in inventory. We would hedge it in the futures market or the options market, or eventually we could move it out the door to somebody who wanted to take the other side of that trade. But we used our own capital and our own balance sheet to make a ready market so that for the customers, starting with the Fed, but also all major institutions, insurance companies, PIMCO, bond funds, etc., they had no difficulty buying or selling bonds pretty much whenever they wanted. That was true in government securities. As you go down the credit spectrum into corporates and high yield and munis, liquidity is not quite as good, but it was always pretty good. Today, that is gone. That model that I just described is gone. And there's some very specific reasons for it. One is the Basel III capital requirements. So they've increased capital requirements on a lot of bonds. Now, government bonds are still, high-quality government bonds still require relatively little capital, but certainly corporate bonds, muni bonds, asset-backed bonds, et cetera, have significantly higher capital requirements. There's the Volcker rule, which has to do with whether you're a proprietary trader versus just making markets for customers. And there are different ways to make markets. You can make a market by taking something on your balance sheet, but you can also just be an agent where you charge a small commission to pair up both sides of the trade, but you never actually take the bonds onto your books. And then finally, the regulators are breathing down everyone's back. So putting this combination together of Basel III capital rules, the Volcker rule, and regulatory oversight, the banks and the primary dealers have in effect been frightened out of committing capital, committing balance sheets. So there is far less liquidity in the bond market than there used to be. And I've spoken to people recently and they said, Jim, things that back in the day would take maybe a few minutes or a few hours to get done can now take days or weeks to fill some of these orders. So liquidity is drying up, but it's worse than that because in addition, a lot of the trading that used to be done telephonically, or you would know the customer, you'd be on the phone, maybe, I'm sure we've all seen pictures of people shouting across trading floors. Today the trading floors are mostly gone, and the ones that are left are mostly silent because so much is automated. Well, inside that automation, you have a lot of algorithms, so now you have a lot of computers trying to front run each other. You have dealers who are not willing to commit their own capital to make two-way markets. You have a lot less liquidity in general for the regulatory reasons I mentioned. So that's kind of a challenging environment, almost a perfect storm for the kinds of things we saw last October, which was a flash crash in the bond market. I think a lot of people know about the flash crash in the stock market. That was May 6, 2010, when the Dow Jones fell 1,000 points in a matter of minutes. But something very similar happened in the bond market in last October 15th, 2014, when yields crashed. Now, prices went up. So the prices didn't crash. They skyrocketed, but the yields crashed. That was like being on an airplane, hitting an air pocket and dropping 2,000 feet just like that, and everyone without a seatbelt bangs his head on the ceiling or gets thrown into the aisle or gets injured one way or another. That's what that was like. And we're going to be seeing more of that, because when the dealers are not there to commit their own capital, and you're kind of left, and customers are left to their own devices, and everything's automated, and all of a sudden some word gets recognized or some trading algorithm gets touched off, and then everyone runs to one side of the boat, and then the market starts moving, and other people, their programs get hit, and people are hitting stop losses, and everyone's rushing for the exits all at once. And in the old days, when everyone was rushing for the exits, the dealers would stand there and stand up to the market because they could see some profit opportunity, but now the dealers aren't there. So we are extremely vulnerable to these kinds of flash crashes. I think we'll see more of them. I think we'll see some that are worse than the ones we've seen already in stocks, but also in bonds. And John, you mentioned at the beginning of the call that I'm one of the ones warning about it, and I am, but I'm not the only one, and I'm not the first. I mean, these warnings are coming from the IMF, from the Bank for International Settlements, from Federal Reserve governors, other regulators. These warnings are being sounded all over the place. And so I think from an investor's perspective, a couple of things. Number one, all the more reason to be diversified, even if you really can't trade stocks or bonds on fundamentals alone anymore. You might have a fundamental view, and there's nothing wrong with that kind of analysis, but you're vulnerable to these flash crashes. You're vulnerable to markets suddenly becoming completely illiquid, and so you need some hard assets, some diversified assets. The gold is kind of interesting in that regard. Gold, it can be a thinly traded market. I mean, there's lots and lots of bonds that get traded, so the volume of bond activity is huge. It's ironic that in bonds you have huge volumes but reduced liquidity. Gold is funny the other way. The volumes are not big, but the liquidity is very good. I've never seen a situation where you couldn't, go out and certainly sell gold if you want to, because there's always a buyer. We might have the opposite problem. There might come a time when people want to buy gold and they can't get it because there's been sort of a buying panic. But at least for those who want to sell gold, I've never seen a situation where there wasn't a willing buyer at a reasonable price, although the market is thinly traded. So gold's sort of thinly traded with good liquidity, and bonds are heavily traded with bad liquidity. As I say, we have enough to be concerned about with inflation, deflation, Fed policy, weak economic growth, cyber financial warfare. There are enough things to be concerned about, but I would add illiquidity to the list, and that is something new. That's something I think a lot of investors assume, because you hear people say all the time, oh, the Treasury market is the deepest, most liquid market in the world. Well, it might be the deepest, but it's not anywhere near as liquid as it used to be. I would add illiquidity in the bond market to the list of things that investors should be concerned about.
So briefly, if I can ask you, from an investor point of view, you're sounding a warning here, but are there systemic implications if there is a major flash crash in the bond market, or if there are increasing problems in those markets? Does that have an impact on the larger financial system?
It does, for a couple of reasons. Number one, and this goes way back in terms of my experience on Wall Street, I'll go back to 1987, when the stock market fell 22% in a single day, not a week or a month, but a single day, down 22%. That would be the equivalent of about 3,000 Dow points today. If the Dow Jones went down 300 points, that would be big news. Imagine it went down 3,000 points in one day. That would be the equivalent to what happened on October 19th, 1987. Now, I've seen that. I saw that there was a bond market crash in 1994. Of course, we're all familiar with the Russia LTCM crisis in 1998, etc. When these things happen, there are always victims, and they might not come out right away. It might come out a couple of days later, sometimes a week later, but somebody goes bankrupt. There's an MF Global or Refco or some firm, in Orange County in the case of the 1994 bond market massacre. Somebody's going broke. And when somebody goes broke, that means customer assets could be frozen, counterparty credit could not be honored. Anyone doing business with a firm probably lost some money. So, of course, you have investor losses. When the market goes down a lot in one direction, anyone holding those positions has suffered at least a mark-to-market loss. But usually there's collateral damage. There's somebody gets carried off the field feet first on a stretcher, and you don't know who it is. And that's the kind of the Lehman Brothers effect. So there's some firm that's not going to make it, and you don't know who the firm is, and you don't know what the collateral consequences of that are. The second thing, and again, I think your question is a very good one, John, sometimes when these flash crashes turn into, not just sort of a mini crash, but something that seems to be spiraling out of control, you can't stand up to the market. I mean, there's no amount of capital to get in front of a freight train that's coming down the tracks at 100 miles an hour. And so what regulators have to do is actually close the markets. You know, the circuit breakers kick in the case of the stock market. We don't really have circuit breakers in the bond market, but there's no reason why the Fed or the securities industry couldn't, on very short notice, get together and just declare that, hey, the market's closed. Sorry, it's like, casinos closed, like that scene in the movie Casablanca when the cops came in. So yes, you could, from these mini flash crashes or worse, not only do individual investors have losses, but generally one or more firms go out of business because their capital has been wiped out. And in more extreme cases, regulators will close markets. Of course, what does that do? That just feeds the panic. The panic then goes from one market to another. Maybe it started in the bond market, but spills over into the stock market or spills over into gold. And the panics can go in either direction. They could be massive losses, but as we saw in the bond market last fall, what happened was, of course, yields crashed, but prices went up, so there were big gains. And you get the flight to quality, so you could have a bond market crash where gold is rallying. Actually, going back to one of the examples I gave in October 19, 1997, my firm made a lot of money because we were not stock dealers, we were bond dealers. And as the stock market was crashing, everybody was trying to buy bonds as fast as they could, so the bond market rallied. So some markets rally while other markets are crashing. But yes, what experts call contagion or spillovers are very likely. So what starts in one market will probably not stay there. It'll spill over into other markets, and in extreme cases, you could see exchanges get closed. Again, another reason to think hard about some hard assets, whether it's, we talked about land, silver, gold, fine art. Obviously, the physical gold fund has a solution there in terms of having part of your investable assets in actual physical gold, not paper gold, not COMEX futures or options or ETFs, but a fund that actually buys physical gold and puts it in safe non-bank storage. So these are ways to sort of stay out of the way of some of these tsunamis or digital meltdowns or nervous breakdowns or spillovers. But I think you make a very good point that this can easily spread from illiquidity and a flash crash dynamic in a particular market over into much more things that are much more threatening from a systemic point of view.
You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.